Hey guys, welcome to the channel Market Uncharted. In today's video we are going to back to the basics. We are going to discuss about fundamentals of investing, taking a look of the main topics we must address before starting to invest. So first of all, key topics. Let's discuss about what are assets, something value that you own, something that adds money value to you. Then you need to know also about liabilities, what you owe to somebody. And then you have the short-term liabilities, like for example credits. Then you have long-term liabilities, for example loans. We have the example of mortgage, etc., etc. Then you need to know how to look at financial statements, which is a tool to review financial conditions of any firm company in a set period of time. What is capital? For example, money, which is an essential prerequisite to run any company or business. Cash flow statements, which is a statement to know cash inflow and cash outflow. And finally, the eighth wonder of the world, the compound interest and how to earn it. Then the class of stocks. Some companies have multiple shares listed on an exchange. Can be, for example, Google class A, B or C. These shares are differentiated by the level of voting rights shareholders receive for holding the stock. Also, quick differentiation between mutual funds and ETFs. This is important because many investors in the beginning don't know the difference between mutual funds, ETFs and index funds. So, mutual funds, investment fund that pools money from multiple investors to invest in stocks, bonds, etc. Trades are processed once per day. When you place a trade, you will receive that day's closing price. Purchase in dollar amounts, which allows you to purchase fractional shares, whereas ETFs are investment funds that pools money from multiple investors but trades on a stock exchange, hence the name, exchange traded fund, and can be bought and sold throughout the day like a stock. Purchase in full shares unless your brokerage allows fractional shares, which is not that common. Then we have the third one, which is index funds, which is nothing more than a passive fund that seeks to track the returns of a specific index. Can be offered as mutual fund or ETF. Example, we have the SPY, which is the index funds that tracks the S&P 500. Then again, more on the difference between the index and mutual funds. I have here a concrete example. VTSAX, Vanguard Total Stock Market Index Funds, which aims to mirror the performance of the market. No peaking of the investments in the fund. Fees are typically lower because they are passive. Then you have VEXPX, Vanguard Explorer Mutual Fund, which in this case aims to outperform the market. The fund manager actually picks what goes into the fund. The fees therefore are higher and they are actively managed instead of passively managed. Then also important to know is the trading hours. Out of the hours trading we need to explain. This is just an example on the New York Stock Exchange and on the American hours. So example, between 4 a.m. and 8 a.m. we have what we call the pre-market. Then between 8 a.m. and 9:30 a.m. we have the normal pre-market. Then the market hours, the stock opens at 9:30 a.m. until 4. And then between 4 and 8 p.m. we have the after hours. Between 8 p.m. and 4 a.m. all stock exchange are actually closed. So pre-market trades place on ECN network between market participants without exchanges. Can be more volatile as analysts update their models of the previous days. There is less liquidity, but the liquidity increases as the opening markets get nearer. Then we have the after hours. Trades place again on the same network. Less liquid, leading to more volatility as there is fewer people bidding for stocks, causing prices to change very quickly. Gives investors the ability to react to earnings report after the market has closed, especially on earnings season. Also important, the stock reports and ratings. This is the scale of ratings that major analysts give. My favorite one is always Morningstar. They have a 1 to 5 scale of ratings where the 5 is a strong sell, the 1 is a strong buy. Please freeze the video to also look at the others. Then the market making, this is also important, the difference between being an investor and a market maker. It's unlikely that at every given moment there will be someone out there who will want to buy your shares the moment you decide to sell. A market maker can act as a middleman to facilitate the transaction, provides liquidity to the market, and also a market maker will buy a seller's share at the bid price and then sell them to buyers at the offered price, making a small profit from the spread for facilitating the transactions. So this is a very important thing to know. Market makers are designed to provide liquidity. Then we also have the pink sheets. This was more common in the 70s and 80s stock market. Pink sheets are listing for stocks that trade over the counter, OTC, rather than on a major US stock exchange like the New York Stock Exchange. Most are penny stocks. They are very risky, low liquidity, and lack of regulatory oversight. Then an important topic as well is DRIP investing, dividend reinvesting plan. This basically, some platforms, some brokers allow you to make automatically reinvesting your dividends. So the dividend payments automatically get reinvested back into the stock as soon as the money gets onto the account. For the dividends, we continue because we always talk about payout ratio. It's important to understand what it is. The payout ratio of a company is the ratio of the total amount of dividends paid out relative to the net income of a company. This also gives a very insight idea of the health and the financial health of the company. When a company's payout ratio is too low, it shows they are focusing more on reinvesting their money rather than giving it to the shareholders. When a payout ratio is too high, it shows the company's dividends are unsustainable and they are giving out more than earn. I personally like a payout ratio between 35% and 70%. Stock market rotation, this is a common theme nowadays between value and growth, and this is important to understand. All markets, all business have cycles. So a stock market or sector rotation is when big money starts to move into new sectors. Money is seen to rotate in a predictable fashion. Specific sectors perform better than others in each stage of the stock market cycle. Understanding which sectors perform well in each stage can help predict where the market is in its cycle. It can also help you rotate your money as well, so you are not focusing on laggards on the market. Range trading, this is nothing more than having a resistance and a support level, and while you look at the price of the stock, you pretty much identify a range where you can trade your stock. Then we have stock options, which is also a very important one. You may have heard the phrase of stock options before, but don't know exactly what it is. But basically, a stock option gives an investor the right, but not the obligation, to buy or sell a stock at an agreed upon price and the date. Then you have the difference between a call option, is when you buy the stock and you go long. Then a put option is when you are thinking about selling the stock and shorting the price. Here I can also put the option contract moneyness, in the money, out of the money, and at the money. The moneyness of an option is the relationship of the current underlying stock price with a specific option contract. Out of the money contracts are less volatile, while in at the money contracts are more volatile. Variable interest entity, basically this is a holding company that created to give investors access to stocks in markets where foreign investment is banned, and this is very common in China. So examples of listed VEI on the stock market exchange in New York is Alibaba, Baidu, and G.com. The listed business has a legal agreement to share profits with the VEE, but zero method of enforcement if agreement is broken. That's why it's always important to know the risks of investing in Chinese stocks in the New York Stock Exchange. And this is important for everyone that know the GameStop scandal, payment for order flow. This is very important on the Robinhood stock exchange as well. Basically how it works. A retail trader places a buy or sell order through their broker. The broker routes that order to a market maker. The broker collects a payment for the order flow. The market maker executes the order at best execution. That's why when you were a client of Robinhood, you were not actually the client, you were the product, and Robinhood would sell your volumes to Citadel, therefore making a payment for order flow. Fun fact, Bernie Madoff, the man responsible for the largest Ponzi scheme in history, pioneered the practice of payment for order flow through his first business. Thank you guys so much for watching this video. Again, never forget, knowledge is not power, knowledge is potential power, execution is everything. And just like the markets, we will not rest.